Hi, everyone. This is Paul Garrard. I'm founder and president of PGPresents, an independent student loan consulting company. We've put together a series of repayment modules designed to help you guys do a better job of managing your student loans. Module number 3 is on how income-driven repayment plans, known as IDRs, how they actually work. Now, we keep going back to this, but a reminder that in module number 1, we looked at 3 simple ways to determine the best repayment strategy, and step number 3 was to actually choose a repayment plan for your federal student loans. In a previous module, we talked about the main differences between time-driven and income-driven repayment plans. We're going to get into more detail in this module on income-driven repayment plans. Now, once again, income-driven repayment plans are simply designed for borrowers who can't afford more aggressive repayment with a time-driven plan like the standard 10-year plan. And it makes sense then that the bigger the gap you have between how much federal debt you have and your income, the more likely you're going to need an income-driven repayment plan. That's why they tend to be so ideal for many medical residents and fellows, because that's the period of time during training when in all likelihood there will be a substantial gap between what you borrowed and what you're making as a resident. The newest plans are pay-as-you-earn, known as pay, and revised pay-as-you-earn, known as repay. IDR, which you've heard about, is a much older plan. We actually have a separate module on how to choose between pay and repay, but those are the newest of the income-driven repayment plans. So once again, the bigger the gap you have between what you've borrowed in terms of federal debt and your income, the more likely you are going to need an income-driven repayment plan. Now, with the income-driven repayment plans, regardless of which plan you're using, the monthly payments are based on a federal formula that looks at income and family size, and the payments change every year. Loan servicers in general will notify you 30, 60, perhaps 90 days before the end of the 12-month period to remind you to renew or recertify your eligibility and your payment amount. We have a double asterisk there to remind you that payments will increase dramatically if you miss the renewal deadline, and in all likelihood, any accrued and unpaid interest will capitalize, meaning that will be added back to the original amount that you borrowed, which drives your balance up. So be sure you do not miss the renewal deadline if you're using an income plan. Now, we want to be cautious about encouraging you to make the lowest possible payment, but what we're finding is that the borrowers we work with who are using income plans are using the payment plan with the lowest possible payment. That's why pay and repay are so popular. Because remember, you can always overpay on the worst loan with no penalty. And if you are trying to qualify for the Public Service Loan Forgiveness Program and maximize the potential forgiveness amount, you want to make the lowest possible payment. Now, there are advantages and disadvantages to using the income plans. The biggest advantage, obviously, is that they provide a more manageable monthly payment for you during a period of time when there's a big gap between what you borrowed and what your income is during your residency and fellowship programs. They can also help lead to forgiveness, either through the Public Service Loan Forgiveness Program or forgiveness at the end of the term, 20 years with pay and 25 with repay. Using an income plan, frankly, using any repayment plan on student loans can help you build your credit, because about 35% of your credit score comes from the timely repayment of obligations, and that includes student loans. There are some disadvantages to using income plans. The biggest one, I suspect, is one you are familiar with. While you're in your training and your payments tend to be very low, many times, in fact, probably most times, the payments are so low they do not cover the interest that you owe on your debt. And so you're making payments and yet your balance is going up. That's called negative amortization. Also, a disadvantage, or perhaps just a characteristic of the plans, you have to renew annually, and so sometimes it's hard to budget in terms of what your payments are going to be and what you need to allocate every year for your payments. And remember that if you are in an income plan and you fail to meet the renewal deadline, your payments will increase dramatically and interest is likely to capitalize. Another reminder to never miss the renewal deadline. And a reminder that unlike the forgiveness under the Public Service Loan Forgiveness Program, If you get to the end of the term with an income plan and you've not retired the balance, the government will forgive it regardless of where you've been working, but the forgiveness amount is considered taxable income. Now, we'd like you to pay special attention to this slide because we would respectfully suggest that if you understand this slide, you will understand a lot about the way that the income plans really work. Because remember, in a time-driven plan, if you make minimum payments at the end of the term, you're done. Your debt's forgiven. There's nothing to forgive. But if you use an income-driven repayment plan, one of three things is going to happen. You're either going to have your debt forgiven tax-free after you make 120 eligible payments through the Public Service Loan Forgiveness Program. Number two, if you don't use the Public Service Loan Forgiveness Program to retire your debt, the second option with an income-driven repayment plan is simply to retire the debt yourself by paying it out of pocket prior to the end of the 20-year term with pay or 25-year term with repay. You can also not necessarily retire the debt, but you might switch the debt from federal debt to private debt through refinancing. But door number three, or the third thing that can happen, is that if you use an income plan and your debt is not forgiven with public service loan forgiveness, and you are not able to retire the debt before the end of the term, as we mentioned earlier, the third thing that can happen is the debt will be retired for you by the government, but they will consider that amount taxable income that year. Now let's take a look at how the payments are actually calculated. Now we're not going to dive into the actual formula. You're going to see a reference to pay and repay being calculated at 10% of something called discretionary income. We're not actually going to look at the formula itself, but it's important for you to know that the formula looks at or uses prior year income from the most recent tax return. Now, many students don't file a return because they don't have any income, or most of them don't have any income their last year. And we are not CPAs or tax advisors, but there is no downside to you filing a tax return because, again, if the formula is going to look at income from a prior year, you can actually file a tax return with zero income. Income increases are going to be captured on a subsequent year return when you renew or recertify your eligibility. So again, we see no downside at all to you filing a return your senior year if you're watching this before the tax filing deadline. We have a separate module on how to actually get or possibly get a zero payment for your first 12 months with an income plan. But once again, this is a little bit of a preview to that. If you file a tax return for the 2019 year and you have a zero income, there is a very good chance that that is what will be used to calculate your payment your first year. The updated IDR application, or income driven repayment plan application, will ask you if you filed a return in either of the prior 2 years, and then it will ask you if you are currently working. But there's been a significant change in the application. It will ask you if you're currently working, and then it will ask you if you are working, if your current income has significantly decreased from the last time you filed a return. The Department of Education is actually trying to help borrowers who had income a prior year and whose hours have dropped or perhaps their income has gone down. Once again, if they are looking at a prior year income and you have a zero tax return on file or a tax return with minimal income on it, the question is going to be, has your current income, and for you that would be as a resident your first year, has it significantly decreased from the last time you filed a return? And for many of you, perhaps most of you, the answer to that will be no. So once again, payment calculations are based on prior year income, and income increases will be captured on a subsequent year return. Now, a bit more on payment calculations for married borrowers. We do have a separate module on married borrowers and repayment we'd encourage you to take a look at. But under all the income plans, the older IBR pay-as-you-earn known as pay, and revised pay-as-you-earn known as repay. Spousal income will be counted if you file a joint return, but note spousal income is always counted with revised pay-as-you-earn, the newest plan called repay, regardless of tax filing status. We have a comparison chart of the income plans that will go into a bit more detail on this on our homepage, PGPresents.com. Once again, if you're married or considering getting married, we encourage you to look at the separate module on married borrowers and repayment. Now, some takeaways as we wrap up this important module on the income-driven repayment plans. Guys, the plans work the way they are supposed to. They do provide manageable payments for someone who has a substantial gap between their federal debt and their income and who cannot afford payments under a more aggressive plan like the standard 10-year plan. But a reminder, the payments change every year, and it's very important for you to renew or recertify your eligibility and your payment amount in a timely way every year. If you are late renewing or recertifying, you can expect your payments to jump up dramatically, and any accrued and unpaid interest will likely be added to the original amount that you borrowed through capitalization, and that is the last thing that you need. We would encourage you to contact your loan servicer about a new process where they can automatically access your prior year tax return data and renew your payments annually for you. So contact your loan servicer about that. There are many residents who use income plans and simply overpay. Just because you're using an income plan doesn't mean you're trying to qualify for the Public Service Loan Forgiveness Program. It simply means you want to start making payments and you can't afford another plan. Work very closely with your loan servicer to apply for the income plans. The application is online at studentaid.gov. There is a box you can check to let your loan servicer choose the plan for you. Do not ever check that box. You should choose the plan yourself. And a reminder that you can switch plans later if needed. This is the end of module number 3.